Yeah, I mean, I think that's really what's going on with the markets right now is people are waking up to the fact, whether they want to or not, that, inflation is going to be a really large problem. We actually put a tweet out on it this morning under at Daniel T. Niles, and people can see the chart on danniles.com, but it shows what 10-year break evens are, which that's a measure of what people think inflation is going to be over the next 10 years. And it's a much better metric than looking at the 10-year treasuries, because the 10-year treasuries, the Fed is in there buying, 80 billion in bonds a month, 120 billion in total debt a month. And so that's artificially low. You look at the 10-year break evens, you're at levels last seen in 2013. And all the inflation metrics that are coming in are all running pretty hot. And you've got, multiple prices at multi-year highs, whether it's lumber, corn, wheat, oil, you pick it. They're all going straight up. And the economies aren't even fully open yet around the world. So I think those numbers are going to continue to get hotter. And within that, tech's the most overvalued sector in the market. And so that's going to continue to struggle relative to areas we like better, like banks or energy, which were our top picks coming into this year.
So what will be sufficient to spark a bit of a sell-off? Is it just a high inflation print tomorrow, or is it then the Fed starting to talk about tapering or even about rate hikes?
Yeah, I mean, I think it's the second thing that you said. I mean, all of these are inputs into the Fed's decision, and the Fed doesn't want to raise rates, right? They've said we're going to keep rates here through 2023. What we're talking about the tapering question, which is they're buying 120 billion in bonds a month. And if you look at it, Canada in late April was the first G7 central bank that said, okay, we're going to taper our bond purchases. Last week, the Bank of England came out and said, we're going to taper bond purchases. And if you look at some of the emerging markets, Brazil's central bank's already raised rates twice. Russia's already raised rates twice. And you've got, I think it's over 10 central banks that have already raised rates this year. So the Fed can say whatever it wants to, but ultimately at the end of the day, if prices keep skyrocketing, they're going to need to respond to that. And I think they're going to talk about tapering and start doing it before the end of this year. And that's what's going to cause a 10 to 20% correction. Maybe that's already started because, of what we're seeing, but that's my prediction.
Is tech still the most overvalued part of the market, Dan? I mean, some of these names have been slashed 10, 20 to 50% off recent highs. Do you see any buys there in that wreckage?
Not really, because, they're down 10, 20, 30%. But, you look at like a Tesla as a great example of this. Revenues were up 28% last year. The stock was up 740%. So even if it's down 33% or so, I think, from its highs, and by the way, we, in full disclosure, we covered around, I think, half of our short today near the close. I mean, it's still way expensive relative to other names you could own. I mean, Magna International, we've talked about before. It was one of our top 5 picks coming into this year. We said it was a much better way to play electric vehicles through that name. I think that stock's still up over 30% year to date. So for us, it comes down to valuation. And within tech, there are names we really like Facebook and Google we can get into. But, you have to be, I think, very valuation centric, because the world, probably for the first time in 13 years since the global financial crisis, is going to have to deal with high inflation. And that changes the playbook completely around what you can invest in.
Shepard Smith here. Thanks for watching CNBC on YouTube.